This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. As a quick setup today, before I jump into my monologue, I want some foundation. What follows is about 10 minutes from Benoit Mandelbrot about efficient markets. Keep this in mind before I dive into my rant.
Professor Mandelbrot, thank you very much for being with us here today.
Thank you very much for inviting me.
Let's start, if you could explain where the efficient markets hypothesis comes from, where it intellectually started, and what it presupposes.
Well, it started precisely in the year 1900, when a man named Bachelier, a French mathematician, presented his PhD dissertation called The Theory of Speculation. It's a remarkable piece of work which has had an enormous influence on theory of probability, enormous influence on what's called Brownian motion. But it was meant to be a theory of the way in which prices vary on markets of securities, of commodities, etc. As such, it had the most bizarre history. For 60 years, hardly anybody paid attention. 6 years later, when the computer became available, when people could really compare that theory with data, the Bachelier theory suddenly became known, people became aware of it, and it began to rule the roost of those who were trying to model the variation of prices on the various exchanges.
And what exactly does the Bachelier theory suppose or posit about the way that markets work?
Well, it posits markets work in an extremely simple fashion. As a matter of fact, it posits that markets are simpler than most physical phenomena, which is quite extraordinary, strong assumption. It posits that, in a certain sense, price goes up or down by a toss of a coin. If it's heads, the price goes up a little bit. If it's tails, it goes down a little bit, and just goes on like that endlessly. If you buy when the price is high, well, you lose. If you buy when price is low, you gain. But it's a model of extreme simplicity, which has, in a certain sense, no parameters. If you scale the time appropriately and the value appropriately, it's the same theory for everything.
So it's a complete random walk, and the chance of a big move on the stock market is the same as the chance of the same coin coming up heads 20 times in a row, for example.
Yes.
That kind of idea.
And the chance of a sharp discontinuity is zero, because the process is assumed to be continuous. Price varies continuously by amounts, which of course in reality one doesn't have the continuous change because one has finite number of readings. But the theory says price varies continuously in continuous time.
Right, and remembering the day early in 2007 when the Dow Jones Industrial Average fell 200 points in 1 minute, that already begins to sound as though it's not a very accurate portrayal of the way markets actually work. Had he actually done empirical work on markets, or was this a theory based on assumptions?
Well, Bachelier did not mention any experiments. Rumor is that he had done some experiments, but they are not reported. He has written about it in other papers of his, but one knows very little about him. He is a kind of mystery man in history of mathematics. He was presented PhD, got the doctorate, and disappeared for quite a while, until much later became professor of mathematics in the provinces. One does not know his motivation very well.
Now, why do you think he appealed to this generation of financial economists who came along in the 1950s and 1960s and came up with all the ideas that undergirded derivatives and the complicated products that we all got to know about last year?
Well, I was present at that time. I was close to that field. The reason was that the computer came, many things could be actually done, tested, data became available, and one was, in a certain sense, was a thirst for existing theories that might help. And here, miracle of miracles, in 1900, a complete theory was discovered, rediscovered in libraries, and one could have already a history. One could pick out of Bachelier all kinds of formulas which answered questions which people were asking themselves.
Now, as I understand it, the Bachelier theory implies that returns follow what we all commonly know as the bell curve, that most things will be clustered in the middle and there'll be just a few wider movements at either end of the scale. What did your research tell you once you started taking a look at this, which is what, in the early 1960s, I believe?
That the tails in question, which are so completely impossible to draw because they're so thin, just a few events, the tails are extremely long. And that a record one looks at can seem to be just small steps up and down, and then one gigantic step. And the gigantic step itself is very often, in a certain sense, segregated. Market stops trading. Trading stops and then resumes at a different value. The question arises, do you take this big, enormous jump as part of the process, or do you say it's an act of God, depending upon different rules? If you say it's an act of God, it fits in Bachelier if you wish, because you have put all the big events under the carpet.
But those big events are actually what matters most about markets, aren't they?
Absolutely.
So what was your alternative idea that you were putting forward 4 decades ago, and why do you think it was not taken more seriously when it came to drawing up the way in which we invest?
Well, more than 4 decades ago.
Right.
It made quite a sensation. It was criticized before it was published, which is a compliment which one doesn't want to have, but which is indicates what happened. My theory was based upon, first of all, an observation, which I made accidentally. I was coming to give a lecture at Harvard, as a matter of fact, and on the board of my host, I saw a certain drawing, which I was going to use in my lecture. So I asked my host, but how come you have on your blackboard the drawing I'm going to use? He says, I had no idea what you're going to say. But this thing refers to price change and refers to the distribution of one price change and next one, the joint distribution. It turns out, for technical reasons which I cannot explain here, that there are 2 different shapes of this distribution, one which goes this way, one which goes this way, and of course you can go in between. Everybody was assuming it was that way.
Right.
What I saw in Blackboard was this way. In other words, the data were presented to me ideal fashion by pure chance. And I asked this chairman, who became my friend, to give me his cards. I went home to where I was working at IBM and analyzed this data and found that this distribution, as I had inferred for my own reasons, represented a situation in which the large price changes, even though few, were so large as to be the most important thing there is.
So that's utterly contrary to Bachelier, in other words. And
my work was very soon criticized, quite sharply, of course. And but the main critic, who wrote a very nicely written story, says that, well, we have known that there were these big values, but since we didn't know what to do with them, we just swept them under the carpet.
So if you're trying to model risk management, and that's the main use that efficient market theory has been put to, is managing risk, they're admitting from the start that they're not trying to take account of the biggest risks when managing risk.
Well, that person did state it very clearly in a critique of my work in a book that he edited in 1963 or 64.
And why do you think that the theory became so popular? Is it because it made investing look easier than it was, that it made the world look simpler than it was, or what lies behind it?
Certainly the word simpler than it was. The reference to Bachelier in terms of influence was not there. I mean, the work would have occurred anyhow. But the theory of Bachelier had become very important as the Brownian motion. And there were books and books and books about it. Many people knew about it. Therefore, there was a certain capital of knowledge, capital of wisdom, which was available and one could draw upon. And on one hand. On the other hand, my work had one, two references, very obscure, not very close to what we're looking at. In a certain sense, my work promised, great amount of work and trouble and effort. And the other promised a capital on which one could live for a while.
So in some sense, this is down to academic politics, that if efficient markets were true, then we can build a lot of theories from it. And if your theory is true, then we have to work a very long time, and we may not find anything that we can use at the end of the work.
Well, it's an extreme version of what I think happened.
I wish that guy was still here. I wish I could have interviewed him for this podcast. As I said, that was the quick setup. Here's my rant for the week. A little bit of volatility in the stock market. The headlines are quite ominous. Now, if you've been around the block a few times, if you've had a chance to witness the media carnage, if you've had a chance to witness the up and down nature of the markets, it's not much of a big deal. But what's similar, as in past manias and past panics, the media is out there trying to work people up into a lather. If the markets don't go straight up, it must be the end of the world. I want to quote a little bit from an article today. What's going on with the stock market? Woo, doesn't that make you want to click bait right away? What's going on with the stock market? Oh, pray tell, I want to know. Written by a nice enough looking author who I'm not familiar with. So let's see who she is. Nicole something, I can't pronounce her last name, part of Yahoo Finance. And her bio, she's been writing about personal finance for 6 years, and she's also the author of Biographies of Ordinary People, a millennial era Little Women. So there you go. She doesn't know what the hell she's talking about at all. But this is what modern media is. Modern media are people that can write cool stuff, sound ominous, follow the script. If you follow their biography, you find out there is no biography, what we just found out. But I don't want to beat her up too much. Let me move on to my larger point and get into some of the content of the fear coming out right now. The opening sentence, not surprising. The stock market has been exceptionally volatile this week. Down, then up, then down again. You can almost feel it, right? Down, then up, then down again. Oh my God. Impossible. Insane. I can't believe it's happening. The next sentence, the most recent drop was particularly steep. Particularly steep. The Dow had its worst day of the year on Wednesday when it dropped 800 points. Wow. Everyone should just panic. Now, she goes on further in the article to reach out to Reuters and some of their technical analysis about what's going on. Here's where it really gets good. Quoting, when short-term yields climb above longer-dated ones, it signals short-term borrowing costs are more expensive than longer-term loan costs. Under these circumstances, companies often find it more expensive to fund their operations, and executives tend to temper or shelve investments. Consumer borrowing costs also rise, and consumer spending, which accounts for more than 2/3 of U.S. economic activity, slows. The economy eventually contracts, and unemployment rises. What are you supposed to do with that information? It tells you absolutely nothing about you, your money, and the opportunities in front of you. It does not tell you, buy this on X day and sell that on Y day. It says nothing. It says nothing at all. It's like just someone's gums flapping to say words that sound smart. It's bullshit. And this is the entirety of financial news. All of it is crap. All of it is useless. None of it helps you to make a decision. Oh, it can help you to make a decision, the wrong decision, but it doesn't help you to make a good decision. It doesn't help you to make a decision in the context and part of a plan. It's noise. Her article goes on to quote Dan Ariely, who has been on this podcast, and he says that paying attention to market fluctuations is the biggest mistake you can make right now. Quoting Dan, if we're going to look at it going up and down, we're just going to be more miserable. We're not only going to be more miserable, but act on it. Well, there you go. I got to give Nicole a little bit of credit. She put Dan in her piece. But that's after she's already rung the bell. So now you've got people who have just crapped their pants. They haven't followed anything for months or a year because the stock market's gone straight up. Now the headlines are designed to panic. Do something. Make it effort. Or just click more on these damn articles and make more ad dollars for the purveyors of such information. Now, at the end of this piece, she goes on to say, I am a personal finance writer, not an investing professional, so I can't give anyone investment advice. But I can tell you that I'm not planning to change my investment strategy yet. I'm still planning on maxing out my retirement accounts and putting additional money into a brokerage account to earn a higher return than I'll get from a savings account or CD. Now, that's a loaded paragraph. First off, investing professional. I don't know what the hell that means. If we're talking about Jerry Parker, that's one thing. If we're talking about your broker, that means absolutely nothing. A guy shuffling papers, placing orders. He is only an investing professional by the law of the United States of America and other investment authorities around the world. But someone that places your orders is not an investment professional. Now, the other interesting, fun little point about her comment there at the end, putting additional money into some other account because she's going to get additional return. Interest rates. What the hell is she talking about? We've now reached the lowest on the 30 just about ever. Most of the developed world is going to negative interest rates. There's nowhere you can park your money and get shit for yield. That's over. It's been over for a decade. Now, I bring all this up, this little bit of an article this young lady's writing, not to really beat up on her too much, because she's not alone. I just picked her out of a hat. But I raise these issues, I raise these points, I raise this cacophony of baloney that's pushed out nonstop to give the counterweight, the balance to the other side. A little interactive exercise with this podcast today. I would like you to go to a particular URL, my URL, trendfollowing.com/events. You will notice at this page a very basic trend following precept thrown right in your face. Cut short your losses and let your profits run on. Now, the fine young lady whose article I just quoted a moment ago does not say that. She says everything else, stuff that makes no sense, stuff that's contradictory, stuff that is just to get the average person crapping their pants. But she doesn't talk about cutting your losses and letting your winners run on. That's the only game in town. Because you can't predict a damn thing. All the economic points that she was making about this particular rate here, unemployment there, none of that stuff translates into buy here, sell there. None of it. You need an approach for that. You need a system for that. Again, on this URL that I am currently looking at with this fine picture of David Ricardo, trendfollowing.com/events. And no, I'm not trying to sell you anything on this particular page, because you will find out if you actually go there that I've taken the time to give you some interesting resources in one place. Some PDFs that you can dive right into, offering perspective on prior periods in humanity where the shit has hit the fan. So when you see the emails pour in declaring that things have changed and here's what will happen next, when none of these people know what will happen next at all, back to the URL, trendfollowing.com/events. This is your resource for everything that counters to the typical narrative. I've assembled it for you in a nice, little, easy to read page, and you should go dig in right now. Absolutely jump in. Because when you start to look at texts like Speculation is a Fine Art, published in 1880, or if you start to look at Business Booms and Depressions since 1775, there's a commonality. Human beings, they act the same, they do the same. We're not really unique. It's the same stuff, decade after decade after decade after decade. And your approach to how to handle that comes from what I'm assembling on this particular webpage. It doesn't come from listening to the young lady who proudly tells us she's a millennial, who's just parroting economic garbage that you can find on a million websites that tells you absolutely nothing. There is a parallel universe kind of thing going on. There's one side of the coin where people get it. They understand how the game works. The other side of the coin is purposefully made to be a mystery, so the average person doesn't know what the hell's going on. That's always the world. The trick is, can you figure it out? Can you logically figure out what's going on, how to handle it at any moment in time, or you're emotionally triggered, you're on a team, you don't know what to do, you don't know how to handle yourself. It's a choice. Now, for those of you that hear a little bit of a passion in my voice, and you think that perhaps I've done the homework that you've not yet done, that you've not yet had a chance to see, that's actually true, at least for many people. You want to go to that page right now and you want to download every PDF that I've assembled, every white paper that I've assembled, and start your education right now. Turn off everything else and go read. Gain the confidence, put the other crap down, and then you're on a path to some financial freedom. And then you're not caught listening to Yahoo Finance articles composed by nice young ladies who proudly tell you that they have a few years' experience writing personal finance articles for millennials. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, Trend Following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.